Welcome to this important financial disclaimer. Please pay close attention to the following information. It's crucial to understand the nature of the content you are about to consume. This disclaimer is here to clearly set the expectations regarding the information provided in this video or related materials. The content presented is for informational purposes only and should never be construed as professional financial advice. We are not licensed financial professionals, and the information shared is general in nature. The sole purpose of our content is educational and informational, designed to help you think about certain financial concepts. Any opinions or views expressed are strictly those of the author or speaker and do not represent professional endorsements or advice. It is absolutely vital to recognize the inherent risks associated with investing and financial decisions. Understand that every investment, regardless of how safe it may seem, carries some level of risk. There is a real possibility of losing some or all of your invested capital. Please be prepared for this reality. Past performance of any investment or strategy discussed is not a guarantee or reliable indicator of future results. Before making any financial decisions, we strongly urge you to consult with qualified professionals. This includes consulting with a qualified financial advisor, tax professional, or attorney relevant to your personal situation. Always conduct your own thorough research, or DYOR, before committing to any financial decisions or investments. In conclusion, your financial well-being is your sole responsibility. By proceeding with this content, you acknowledge and accept this financial disclaimer in its entirety. Thank you for watching and listening, and we wish you the best in your financial journey. Welcome. Today we delve into the core of economic management, monetary policy tools, and their significant impact on financial markets. Central banks use a variety of sophisticated instruments to manage the economy, aiming for stability and sustainable growth. Understanding these tools is crucial for anyone involved in finance. Monetary policy tools are the mechanisms central banks employ to influence the availability and cost of money and credit in an economy. Their primary role is macroeconomic stabilization, specifically controlling inflation and managing economic growth to avoid severe recessions or overheating. Let's look at the three most commonly used monetary policy tools utilized by central banks globally. First, we have interest rate adjustments. By changing the policy rate, like the federal funds rate, central banks affect the cost of borrowing for commercial banks, influencing economy-wide interest rates. Next, open market operations, or OMO, involve the central bank buying or selling government securities. This is a direct way to inject or withdraw liquidity from the banking system. Finally, reserve requirements dictate the minimum amount of cash banks must hold in reserve. Adjusting this ratio impacts how much money banks can lend out. Now let's explore how these tools ripple through financial markets, starting with interest rates. When the central bank raises rates, borrowing costs increase for consumers and businesses, often cooling investment and spending while encouraging saving. Policy rate changes also directly influence the bond market. Lower interest rates generally lead to higher bond prices and lower yields, and vice versa. Next, let's examine the powerful effect on market liquidity, the ease of trading assets without affecting their price. OMO and reserve requirement adjustments are key to managing the money supply. Buying bonds injects cash, increasing liquidity. Raising reserve requirements locks it up, decreasing liquidity. These actions significantly impact short-term interbank lending rates, which are the fundamental costs that banks charge each other for overnight loans. Finally, monetary policy has a crucial impact on the valuation of broader financial assets. Lower interest rates often make equity and real estate investments more attractive compared to bonds, leading to increased demand and potentially higher asset prices. Central bank communication, or forward guidance, is also a powerful tool. Clear communication about future policy intentions can stabilize market expectations and behavior. Monetary policy tools are intricate and essential instruments for economic governance, with wide-ranging effects on financial markets. Interest rates, OMO, and reserve requirements control the cost and availability of money, directly influencing debt markets, liquidity, and asset valuations across the board. Effective monetary policy is indispensable for maintaining financial market stability, making these decisions critical for the health of the global economy. Thank you for watching.
If you found this video helpful, like, share, and subscribe for more simple finance explanations.